Welcome to our preparing for the end of financial year video for folks with crypto. In today's video, we'll go through some tax planning and year-end preparation tips that may put your taxes in a favorable position for the end of financial year 30th June 2024. So let's go through a quick disclaimer and a bit about us before getting stuck into the video. So as always, the content of our videos are general in nature and may not relate to your specific situation or circumstances. So we encourage you to seek specific advice, tax or legal, as it relates to your affairs. If you want to reach out to us about your situation, you can leave a comment or visit our website. You can leave a note in our contact us form or schedule an appointment directly from our website or via the details at the end of the video. So a bit about Fullstack Advisory. We're a firm specializing in crypto tax and compliance. We provide meaningful advice and solutions to the crypto community. We also provide additional services as well to the wider community, including tech businesses and startup, other businesses as well. We also provide R&D, research and development, virtual CFO services, and more. We're unique in our hands-on approach, and we pride ourselves as working closely with our clients to achieve their goals. So on today's agenda, we've got the recent ATO developments. It's pretty juicy. Remaining compliant, tax planning, preparing for the end of the financial year. Beautiful. Let's go. So the recent ATO announcement with regards to its data matching program. So this was published in April 2024, titled Crypto Assets Data Matching Program Protocol. ATO goes into a bit of detail here. They basically advise that the program will be used to collect data from the 2015 financial year all the way through to the 2026 financial year. And this program will enhance the previous data matching capabilities that the ATO had employed previously, and it has a number of objectives. So, obvious one, ATO wants to ensure that everybody is accurately reporting their affairs and doing so correctly. So, promoting compliance is obviously going to be number one. Identify and educate individuals and businesses that may not be compliant. So, we're looking at the ATO looking to collect data and identifying maybe some individuals, maybe reach out to them specifically about addressing their crypto, how it ought to be reported. But this could also be through other means like providing more detailed guidance perhaps, or other means. So gathering data to implement strategies to improve compliance. I mean, this could really mean anything. This could be increasing the number of alerts or notifications given to taxpayers. So we see a lot of the time on the ATO approval reports, if they suspect crypto, they're typically advised there's been a crypto disposal, this needs to be reported. Really, we're not entirely sure, but it's likely just going to improve the notice given to taxpayers to ensure that it is being reported. We see with shares, we see with property, where they're disposed, they're on the pre-fill report. So this is another way that it gets captured. Also, it lets tax agents know as well when their clients are engaged in crypto. They may have forgotten about it. There may be a few transactions that they just completely slid their mind. This will prompt the tax agent to ask those queries and follow that up. So gather data that will increase the ATO's understandings on the behaviors and compliance profiles of individuals and businesses buying and selling crypto or receiving crypto as payment. This is very interesting, maybe a little bit concerning. We're not exactly sure what it means to have the data being used to understand the behaviors or compliance profiles. Not really sure at all what that means. There wasn't a whole lot to go off of from that. However, be rest assured that data will be used as part of the ATO's internal systems, maybe part of their risk assessment or otherwise. But the ATO does advise that they're across the data privacy laws. So rest assured that the data will be protected. However, having access to that data, I think, is a little bit worrisome for many. Improve the ability to identify taxpayers, which the ATO will select for reviews and audits. So this is pretty obvious as well. I think the ATO wants to make sure that people are actually accurately reflecting their affairs in their tax return, doing so completely. And if it suspects that it's not, then you can be assured that you'll receive some sort of notice in the form of a review or audit from the ATO, asking questions and investigating that further. So understand the level of risk crypto assets pose to the tax system and measure the effectiveness of the ATO's treatment programs. So these two are the main standouts, at least for me. So the risk to the tax system, I think, is quite large. So considering the data matching capabilities will likely be to centralized exchanges, collecting data from on-chain transactions via hot storage wallets like your MetaMask and Trust wallets, that seems like an impossible task because there's no KYC procedures or anything directly linking people to those wallets except for transactions interacting with them. So it seems virtually impossible that the ATO will be actually have systems, maybe at least currently, systems that are sophisticated enough to pick up those transactions. And I think without certainty of what those transactions entail, it creates a void in the ATO's data that it collects. Obviously, the onboarding and offboarding of fiat currency is done via centralized exchanges, and the connection is always to the bank account. There's obviously the activity that's incurring in between and outside of those centralized exchanges, which pose a pretty significant risk. Also, there's a significant risk, I believe, to self-prepared tax returns, particularly using crypto tax software, maybe some being advertised as be all, or just plug in the data and have the reports prepared without going through a review process of those transactions to ensure that they are being recognized correctly for what they are and categorized correctly, may pose a risk to that being reported correctly in the tax return. So speaking from experience, that tends to happen a lot. Typically for the worse off situations would be inflated gains and lower realized losses because of the lack of some data. Sale transactions are typically recorded correctly. However, it's not likely going to have a full picture of what those activities are actually and how they're being reported in the tax return is another thing altogether. Also, the ATO's treatment programs, I mean, this is quite disappointing as some of the guidance from the ATO doesn't really seem correct, but also there's not actually enacted legislation for a lot of the guidance that the ATO is actually putting out. So treatment programs, I would suspect, would be their guidance on how crypto ought to be treated from a tax perspective. However, we really do need some legislation to substantiate a lot of these guidances. However, we are a bit at the ATO's mercy in this regard. The ATO's guidance is typically how they view particular types of transactions. And if we have a view to the contrary of that, and we don't apply for a private binding ruling, then expect a battle with the ATO if they ever review or audit the return that has crypto in it, and we have not followed the ATO's guidance in reporting that particular activity. I know there's quite a few people in the community and clients of ours who have particular situations which don't really align well with the treatment that the ATO or the guidance that the ATO has out, and leaves us in a pretty unusual situation of, well, what do we do here? All right, so moving on. So remaining compliant. So with the ATO's obviously improved data matching program, it will likely lead to an increase in notifications that taxpayers receive, either through SMS or messages through MyGov or other means, that, hey, we noticed that there's crypto activity, and there will be advice in those notifications to report that activity in the tax return. So first off is report all of your crypto activities. So again, to address a pretty common misconception that we deal with quite frequently is that, oh, I had cryptocurrency activity previously, but I didn't report anything because I didn't actually make any profit or money from it, right? So what those folks are talking about is that, hey, I've made a capital loss, I didn't report it and didn't go through the hassle. However, that is a significant risk nowadays. We've actually seen this happen before where you have capital gains events being triggered, the ATO being aware of those particular sale events, and without actually being able to substantiate the activity, the ATO we've seen actually has, at least in the instances that I've come across, they actually have the type of cryptocurrency being disposed, the quantity, the date, and the value, right? Now, if you made a capital loss on that transaction and the ATO can only see the sale, they're not trying to match up the purchase or the cost base and etc. That's for you to substantiate, and that's for you to keep records, right? So without being able to substantiate that, without those records, the ATO will assume a cost base of zero. And what happens when there's a cost base of zero? Well, even if you made a capital loss, the gain is going to be 100% of what you sold it for, because there's no cost base to reduce the sale proceeds. So absolutely disaster situation. So I would heavily encourage anyone with crypto or anyone with clients that have crypto to report all of the affairs, all the activities from the inception of when the activities actually started, and start bringing those things to date in the return. Another thing is substantiate where required. So it's important to understand that when you're preparing your tax reports, your crypto tax reports, by themselves, sometimes it might not be enough to satisfy a detailed audit or review from the ATO. We need to make sure that if there's any additional documentation that we need to keep, it needs to be kept, right? So this will include records such as what data we're actually putting in through the system that's producing the tax reports. So this could be the full history data from centralized exchanges, some cold storage wallets, as well as keeping a logbook or similar document to detail all the hot storage wallets, the minimise trust wallets, and the various networks that are being used as well, if they are applicable. So a lot of the time when we're going through clients' transactions, we see some transactions that are pretty vague, and without any context or documentation to substantiate the nature or prove the nature of what that transaction is in relation to, leaves us in a situation where we may not actually be able to achieve an appropriate tax outcome that would improve our client's overall position. So you need to be very wary that it's sort of like with deductions. You incur the expense doesn't mean that you're automatically going to receive a deduction. You need to be ensuring that you have appropriate substantiation and documentation or a reasonable basis calculation to deduct that expense. So it's not an automatic entitlement that you receive. It's something that you still need to do a bit of work on to make sure that you can actually include it in the return. So similar with the tax reports, the crypto tax reports, we need to make sure that that information, that detail is there. So just to touch on that a little bit further, so substantiation may be required where some transactions aren't clear. So these could be indirect swaps, or maybe purchases at one date, but there's a particular release mechanism for the cryptocurrency that's being acquired with different dates for payouts and things like that. ICOs is pretty common in that regard. But another thing as well is when cryptocurrency has become, when it's lost or stolen, making sure that gets documented accurately as well will ensure that you can actually claim a capital loss for those particular transactions. And obviously, loss of stolen crypto can be arisen through scams or hacks. There might be one that's pretty noticeable, may have been reported on a website. Just keeping a document, something like that, something third party that helps to substantiate those transactions may assist if the ATO ever reviews and audits and says, well, hey, can you prove that this was actually stolen, or what else have you? So another important procedure to implement in this regard as well is to take screenshots of your holdings wherever they're held. So if you've got multiple exchange accounts, probably not so relevant for exchange accounts because most of them you can extract a closing balance statement at a particular year. However, it is important to note that all exchanges operate slightly differently and the reports and data available is presented slightly differently. But absolutely for hot storage devices, if you have a MetaMask wallet on the 30th of June, take a screenshot of what's in there. Make sure that you are changing the network with respect to what networks you actually have assets on, and take screenshots of those. It's not crucial to do that, but it definitely makes things a lot easier to prove, well, hey, I did actually have this at the end of the financial year. And it also assists anyone preparing the tax reports to have something to refer to go back on to make sure that all the data is being recognized correctly in the system. So that's pretty important. Another one, prepare your affairs accurately. So this is very, very important to not only mitigate any unnecessary taxes, but when reporting your tax affairs, encouraging the use of preparing crypto tax reports is very important, where you have multiple sources of data and you have multiple accounts interacting with one another. So if there's deposits and withdrawals from exchanges and wallets, making sure that you have a system that is sophisticated enough to recognize those is very important to actually collate it in an economical way and a feasible way to then have it reported in your tax return. So it's a very good tool to amalgamate all the data and report it all in the one place. So the reports will typically include all of the deposits and withdrawals in every form that's taken place. So be it swaps or sales, airdrops, other income, gifts, if there's any outgoings due to theft or scams, something that's become lost, and so on. So it's also important to note that when we're looking at collating our data, that it is actually quite difficult to do so. Like I mentioned before, every exchange does so slightly differently. How you're required to generate an API key with read-only access or extracting data may be different depending on the exchange you're using. There may be separate features on the exchange as well. There may be a futures, there may be a spot, and there may be other features on that exchange as well. It's important that all that data is being collected or extracted from that particular platform and imported into the tax software. Right? It's very, very important to ensure that everything is being picked up correctly. And also that the means of doing so may be slightly more complex for others. And in some means, we may need API keys and data files as well with full history transactions. So very important to take note of what methods there are to extract the data and how to do that for all the data with respect to what you're using. And lucky last, use the services of a crypto tax specialist tax agent. This is very, very important. We see a lot of affairs from folks in the community that are very complex. And chances are, where there's been self-reported crypto, typically there's amendments and changes being required because not everything's being picked up correctly. So if you're not confident in what you're doing, it's best to ask someone who's actually a professional and has experience dealing with those matters, and they can also provide some meaningful assistance and guidance moving forward. So tax planning overview, what is it? Tax planning is traditionally done for businesses and entities such as trusts and companies, where typically in those situations, we'll look at how much income is there from a trust, should we distribute, who should we distribute to each beneficiaries, if the company should pay out dividends, with respect to everyone within the particular group, their taxes, estimated taxable positions, and so on. And there's some other steps as well that can be taken to, proactive steps that can be taken to improve the overall taxable position for those entities. But it's important to note as well that the importance of tax planning isn't exclusively for those entities or for group structures with those arrangements. It may also greatly improve your taxable position if you have crypto, right? So tax planning is basically, by definition, a proactive measure that is a way to utilize the law to achieve a positive outcome when you prepare and lodge your tax return. So typically that's in the form of paying the least amount of tax possible within what's allowed in the law. So these are all actions that we can take now that can have a positive impact afterwards. So let's have a look at some of these. So we've got some measures here. So the first one is to review your portfolio to identify opportunities to improve your overall portfolio or your taxable position. So what do we mean by this? This could be disposing liquid assets. So this could be done by sending it to a burner wallet address. Typically, if assets are illiquid and they've previously been purchased, it will likely trigger a capital gains event that will result in an ultimate loss. And in doing so, you will effectively offset any previous capital gains. And in the market that we're in at the moment, we would suspect that would be quite a few of the folks with crypto. So having capital losses and cleaning things up in that regard will help to offset the gains made throughout this market. Just touching on that, a common misconception that we find with investors is that the capital losses, they're great because they'll reduce my taxable income. But that's not exactly true, and that's not how capital losses work. So capital losses, they'll work to reduce your capital gains, okay? And if there's an excess of over capital gains, then the amount will effectively be carried forward. The amount will be carried forward to later income years, and as soon as it is able to be used, it needs to be used against any capital gains that are made in the future. Okay, so a few things there. Yeah, obviously that it won't offset any of your other income, so pretty important there. The other income as well from crypto specifically may be from staking rewards, interest and airdrops. Actually, that's quite a common one that we see, a big misconception there that there was a lot of staking rewards received whilst prices were high and subsequently selling at a later date for a loss. That loss won't offset the amount of income that was received or generated through the staking rewards, interest or airdrops or otherwise. That won't. So you will pay tax, or the staking rewards will increase your taxable income and the capital losses will not. Next one. So disposing of underperforming assets is something to consider as well. In reviewing your portfolio, if there is any significant unrealized losses, again, an opportunity to consider disposing of those, triggering the unrealized loss and realizing it, triggering a capital loss. And again, where those capital losses can be used to offset capital gains and obviously reduce your overall tax liability. If you're carrying on a business trading cryptocurrency, you'll be aware that the treatment is different to investors. So where we have crypto assets being used in a business, it actually is done so according to the trading stock provisions. So one of the most material things here is that the closing stock cost or value, whichever one's lower typically, will be reportable as income. So it actually increases the overall net profit of the business's activity and therefore the taxable income. So this would be irrespective of where the activity is being conducted. If it's being conducted as an individual or in a company or a trust or a partnership, doesn't matter. This tax treatment would be the exact same. So what does that mean? So it makes it important to review the portfolio and also anticipate what the closing balance figure is going to be, right? I mean, if it's quite high, then you may consider selling some of the closing stock. So then you could at least have the fiat currency to allocate some savings to the tax side of things, as opposed to having a very high closing stock figure. And then in 3 months' time, the value of that trading stock figure goes down significantly. And now you have not enough stock to pay the tax liability, or significantly less to pay for the tax liability. So selling some now is something to consider, absolutely, when we're looking at anticipating the year-end taxable position, the year-end taxes to pay, and budgeting for that. Of course, looking at expenses and deductions. So consider bringing forward any expenses. So depending, I mean, look, this gets advertised everywhere, where, buy a car, buy this, buy a new computer, buy a tablet. People get really excited. This needs to be taken into consideration with a reasonable mind. Like if you need something and you're considering getting something in the next few months, maybe it's a good idea to get it now, as opposed to just looking for things to purchase just for the sake of getting a deduction. You're not going to get as much back as what you're actually paying in most instances. So, you need to take that into consideration. Do I actually need it? And if the answer is yes, and you have the capital and it's not going to put you in an awkward position cash flow wise, it may be worth actually bringing that forward into the 2024 financial year so it can be claimed as a deduction then. And we have until the 30th of June to do so. Now, another sort of precarious situation is with regards to the instant asset write-off. So the amount is not actually yet confirmed. It's likely going to be 20,000. However, it's actually not enacted that is going to be a thing. So it's been passed around through Parliament quite a bit. They wanted to increase it to 30,000. There was a bit of back and forth. And here we are nearly at 30th of June with a lack of clarity as to what the amount is actually going to be. And depending on some industries, a $10,000 difference and getting an immediate deduction can be quite significant. Okay, so it is quite disappointing that the politicians are sort of playing around with this. However, they're likely going to have a response sometime in June when they meet again to discuss it. I would bet that it would be capped at 20,000. Given also the state of the economy at the moment and with inflation, it'll likely be 20,000, but we'll see soon. That also actually just gives us a short window to actually utilize that as well. So another important thing to touch on with respect to that is we may only have a few weeks, 2 or 3 weeks potentially, to utilize the instant asset write-off with certainty, which means that we need to make sure that if we're acquiring assets, that they're actually effectively in use by 30th of June. So, buying something midnight, 29th of June online and it's stuck in freight, that's actually not available in use and therefore won't be likely eligible for an immediate deduction. And it would be deductible when it is, or depreciated essentially when it is in use, which may be after the financial year. Also, we do have some clarity as to the instant asset write-off for the next financial year, just not this year. So a little bit weird. Okay, so the next one is identifying opportunities to transfer assets to a tax-effective structure. So this one's also very, very important to consider the overall strategy. So when we're looking at the portfolio, we want to be looking at opportunities to utilizing a entity structure that could help to reduce your overall tax exposure, mitigate risk, etc. So setting up new entities and performing your investment or trading activities in them can have other benefits as well, but it is very important to consider doing so now. You may, whilst you're looking at the portfolio, you may consider things such as assets that are trading pretty equally, not too much of an unrealized gain or unrealized loss, and anticipating what your future goals are going to be and how a structure could be implemented in place to help facilitate that goal and provide some pretty good outcomes for your portfolio as well in terms of mitigating taxes and improving succession planning as well. We've seen plenty of clients who have purchased, BTC for $1. There's quite a few of those still. You're not going to be transferring those assets to a tax-effective structure, realizing a massive capital gain unintentionally. So careful consideration needs to be applied here to identify what the tax implications are going to be. And using that information to make a pretty informed decision is absolutely critical to getting it all done right and getting a good outcome. All right, so preparing for the end of financial year. So starting off, looking at record keeping, there's very little that we can do right now because we don't have a full year worth of trading. However, it is important to note that we do need it and we need to do so according to the platform that's being used. Full history transaction data is absolutely required from all platforms. Cold storage devices have this as well. So we need to make sure that the data is all there as well. It seems pretty straightforward, but oftentimes actually extracting the data and looking at it, there is things being omitted, or maybe it hasn't been extracted correctly. And being very wary that the data may not always be available for you to extract. And I don't think it's a feasible strategy to be relying on the support of whatever exchange or platform it is that you're using for them to extract the data for you. So best to do it yourself in a proactive manner. Set an alert to do so 30 June or very early July to make sure that you've got it there to tackle out your tax return. Obviously, as well, that it's doing it as early as possible is going to give you the best opportunity to basically recollect your activity. A lot of the time, we see clients having to do this for 3 or 4 years ago. And, you know, some people, we can't remember what we did yesterday, what we had for breakfast yesterday. So doing so the earlier, the better, the more likely it is that you're going to realize, hey, this is missing. This is a pretty significant deal. I need to make sure that this is included. And making sure that you've got that is absolutely critical. To have the raw data unedited is really necessary to have that. All right, so another thing is we need to be careful of the key tax due dates. So if you don't have an agent, expect to lodge your tax return with a due date of 31st October. If you do have an agent, typically you'll receive a concessional lodgement due date to May the following year. And this may be absolutely necessary to actually have enough time to collect all your data. Sometimes doing so early in the financial year is not enough time. Maybe in the preparation of the reports, there's a lot of back and forth in getting it right between your tax agent and yourself, because there may be a significant amount of activity. There may be new networks being used, new coins, and things like that may prove to be challenging to work through and result in delays. So having that additional time is, in a lot of instances, very useful to have. However, it can also be used to delay the payment of your year-end taxes and being wary of when taxes are actually due. So depending on when you lodge your tax return will have an impact on the liability from the tax return is actually due and payable. And if doing so at that end of the financial year, or that end being in May, then you're going to give yourself enough time to identify how much there is to pay, because we've gone through this process in tax planning, and you're got from now till then to essentially save from your trades and fund the liability. Also, reviewing your affairs, the budget for your taxes as well. Obviously, these two things go hand in hand. How much do I need to pay? When do I need to pay it by? Very important. Also worth noting as well that if there is enough income from capital gains and business activities, the ATO may put you on the pay-as-you-go installment program, which is basically paying forward your income taxes on a quarterly basis. There may be many of you that are already on that track. It's important that the ATO will use the data collected from the previously lodged tax return in calculating what that installment amount ought to be. So having this understanding of your affairs should allow for greater budgeting potentials and avoid the nasty surprises and shocks. Also, it's important to review the affairs, estimate the tax liability, and work out how we're going to pay that early on. Can we save up enough time by the time it's actually due? Do we need to consider payment plan arrangements? Strategizing that with the portfolio as well. It might not be a fantastic time to sell some of the portfolio. You may not want to for other reasons. And therefore, trying to delay that as long as possible may be beneficial in securing the value of your portfolio if you haven't proactively taken out or put aside a percentage for your income taxes from when you've made capital gains transactions, where we see pretty much all the time the swaps happening all over the place, probably more swaps than cashing out to fiat. So it's more than likely that it hasn't been done. However, that is definitely something to consider moving forward, and making sure that you are allocating some of those gains to your taxes at the end of the year will mean that this becomes less of a relevant issue. And maybe in doing so and budgeting for the taxes, you can use that more as working capital to reinvest, albeit with its own set of risks. And like I mentioned, with the key tax due dates, need more time, use a tax agent. You get the concessional lodgement extension, 15th of May typically. There are some other factors that may influence the tax return due date as well, such as the size of the liability, bringing forward the tax due date even with a tax agent to typically around April. And there may be other implications as well impacting the tax due date that will need to be considered. So always worth discussing these matters with your accountant as part of the year-end tax planning and just being proactive in getting ahead. All right, that wraps up our video for today. Hopefully everyone found that useful. As I mentioned at the beginning, if you wanted to schedule a meeting, you can use the link here. Also, our other contact details are there. I hope you guys all have a lovely day and take care. Bye.